Hello, this is Kirill from forexboat.com and welcome back to the course on Forex Trading. In today's tutorial we will talk about bulls and bears and buying and selling on the Forex market. Perhaps by now you've already heard about the two creatures that dominate the Forex market, and these are the bulls and the bears. So the bulls stand for Forex traders who invest in the growth of a currency pair. Here we've got an example of the British pound dollar in an upward trend, and in this case the bulls would be active and they would be buying this currency pair, and then in order to close it later and profit from the growth in price. And in a minute we'll discuss the mechanics behind that. Bears are people who invest in the decline of a currency pair, and this is an example of the euro-US dollar in a downward trend. Here the bears would profit from selling this currency pair. The terms bulls and bears have a historical background, and they were first introduced a long time ago in the stock market. The choice of animals has quite a lot to do with the way they attack. A bull would fling up its opponent into the air, and that is similar to how currency pairs move upwards. A bear would generally attack by using its paws to drag somebody down, and that's similar to how currency pairs move downwards. There is a bit of a difference between the Forex market and the stock market, and that is because the stock market, the way it's formed, people associate bears with kind of negativity or a pessimistic approach, since the bears are selling, and when you sell a stock you think that the company is going to underperform, it's going to fail, and you want to short sell that stock, and we'll talk about short selling in one of the future tutorials. But generally that's a pessimistic kind of approach, whereas bulls are happy creatures that are aggressive, that look forward to something growing and becoming more valuable, like a stock for example. But on the Forex market that is very different. Bulls are still the same, they're looking for something to grow. Bears are not pessimistic. Bears just invest in the decline of a currency, but there is no actual company behind this currency. It's not a stock. So by investing in the decline of the euro-US dollar, you're just saying that the euro will drop, but the US dollar will grow. So in a way, you're actually investing into the growth of the US dollar. So that's something to remember, that bears are not bad. Anybody can be a bear, and moreover, most traders will sometimes be a bull and sometimes be a bear. So you can buy in one case and sell in another case depending on what your analysis tells you, and we will talk more about that in the Forex analysis section of this course. Alright, moving on. Today we will talk about bulls and buying on the Forex market. Let's look at a British pound dollar example. And here we can see an upward trend. Let's assume that a bull trader bought at that point in time marked by the cross, and the transaction was conducted at a quoted price of 1.4400 for the British pound US dollar currency pair. As we recall from one of the previous tutorials, this means that at that point in time every single British pound was worth $1 American dollar and 44 American cents. Then let's assume that the trader waited for some time and closed his transaction at the price marked by the second cross, and the quoted price at the time was 1.5950. So this bull trader knows what he's doing, and he made money through this transaction on the Forex market. Let's understand how exactly that happened. Let's look at the mechanics behind it. So let's assume that the bullish trader had $1,000 to invest, which he put into the British pound at a quoted price of 1.4400. Now, as we did previously, let's simplify this example by replacing the British pound with apples, because apples are also tangible. We can hold them, count them, measure them, weigh them up, and we can always replace the base currency with apples to simplify things. So now our example says that the trader had $1,000 which he invested into apples at the price of $1.44 per apple. This means that he bought 694 apples. Next, he waited a certain number of days until the price for apples grew to $1.5950 per apple. And at this point in time, he still has 694 apples. What he did with these apples next is he sold them at the new price. And in return, he got $1,107. So as you can see, he started with $1,000 and now he has $1,107. So if we break this final amount up, we can see that $1,000 is the starting amount on his account, and $107 is the profit that he made. Now moving back to the British pound, we can see that nothing changes if we replace apples back with the British pound. The trader invested $1,000 into the British pound. He got 694 pounds. Then he sold them at a higher price, got $1,107 back, and that is his profit, $107. So he got his $1,000 back, and he's got $107 extra on top of that. So in Forex, the first transaction is called buying. The second transaction is called closing. So even though he actually sells the British pound for dollars, because this is the second part of a buying transaction, or this whole one integral transaction, it is in Forex we call it closing rather than selling, so that we don't confuse things. So you open transaction by buying and then you close that transaction. So these are the mechanics behind a bullish transaction on the Forex market. In the next tutorial, we will talk about short selling on the Forex market and the mechanics behind that. And further down the track in this course, in one of the tutorials, we will talk about leverage, and I will show you how this trader could have made much more profit using leverage, even with the same starting deposit of $1,000. Thank you for your attention today. I look forward to seeing you next time, and until then, happy trading.